Welcome to the LP Financial Services Forex training class, Introduction to Trading Strategy videos. In lesson number 2, Trading Psychology, we're ready to talk about part 1, Crowd Psychology. Typically when people talk about psychology in the markets, they reduce it to the emotions of fear and greed. Likewise, the typical response is to try to avoid these feelings. In many ways, this is a futile effort in that those emotional responses are natural and are not going to go away. A better approach is to accept that reality and learn how to become aware of their influence on a decision and also aware of their influence on how a currency might be acting. Two simple ways to address this issue are to always ask yourself the following two questions. Question number 1, is my analysis being impacted by what the crowd is doing? If you believe you are being influenced by the crowd, take a step back. Confirm your analysis and be sure that as an individual investor, you are acting based upon sound reasoning. Question number 2, is my analysis being colored by the result of my last investment or trade? If you have missed a portion of a market movement because you were previously stopped out, or if you have taken some profits but got out too early, be sure your decision to trade is based upon the current market conditions and not the past market action. Crowd psychology and trader perceptions influence the foreign exchange market in a variety of ways. The following are 4 examples how crowd psychology plays a part in decision making. The first example is flights to quality. Unsettling international events can lead to a flight to quality, with investors seeking a safe haven. There will be a greater demand, thus a higher price for currencies perceived as stronger over their relatively weaker counterparts. Crowd mentality will then push prices even higher as investors lose their fears to enter the market when they believe they are part of a larger group. The second example would be long-term trends. Currency markets often move in visible long-term trends. Although currencies do not have an annual growing season like physical commodities, business cycles do make themselves felt. Psychoanalysis looks at longer-term price trends that may rise from economic or political trends, and this mass mentality has a strong influence on the market. The third example, how this could affect crowd psychology, is the buy the rumor, sell the fact. This market axiom can apply to many different situations. It is a tendency for the price of a currency to reflect the impact of a particular action before it occurs, and when the anticipated event comes to pass, react in exactly the opposite direction. This may also be referred to as a market being oversold or overbought. To buy the rumor or sell the fact can also be an example of the cognitive bias known as anchoring, when investors in groups focus too much on the relevance of outside events to currency prices. And the fourth example of how crowd psychology can impact currency prices is through economic numbers. While economic numbers can certainly reflect economic policy, some reports and numbers take on a talisman-like effect. The number itself becomes important to the group market psychology and may have an immediate impact on short-term market moves. What to watch for can change over time. In recent years, for example, money supply, employment numbers, trade balance figures, and inflation barometers have all taken turns in the spotlight. This has been a good example how crowd psychology can affect market psychology. In our next video, we'll move on to part 2, individuals, investor psychology.